We all want to get rich. We want to do it legally with no effort. And most of all, we want to do it fast. Sounds impossible? Well, it's not. You can do it by simply trading penny stocks. But since you're here, at some point you've realized the giant risks involved. That's why we have 4 main points we'll cover in this video, and they all concern the biggest risk factor, the pump. Here they are. 1. An inside look at the penny stock markets, why they are especially prone to pumps. 2. An explanation on what pumps are made out of, how they work, and the things that you can read in a pump letter. 3. Share dumping. Who would win from the dumping and how? And finally, 4. We'll try to give you advice how to play pumps better, if that's what you want to do, and when to quit. As a side note, I want to tell you that you should stay away from pumps. Playing a pump is like playing with fire, and I'm sure you've heard what people say about that. There are much better and safer ways to make money, but if you're watching this video about pumps and dumps, I'm sure many of you will want to play the pump, and we'll offer some tips on that as well. We'll also give you an example of a pump while we cover the points, and a pretty famous one too. So let's begin with subject number 1. There's only one word you must never forget when dealing with penny stocks: volatility. Penny stocks have the widest swings of any market, and with good reason. Why, you may ask? It's simple: the price levels. Let me give you some perspective on what I mean. Take a look at Tesla Motors, probably the hottest pick on the Nasdaq for the last year or two. As of this video, the company's share price is $230. There's a lot of stuff you can buy with that much money, but that's not the point. The point is, most people are very reluctant to invest on such prices. Would you give $2,000 for less than 10 shares, on which maybe you won't profit for months? Now, take a look at this. The price of this fancy coffee is $4. There are penny stocks out there worth 1 cent per share. Just imagine if you invest 1 cup of coffee in one of those stocks and the price suddenly skyrockets. There are extreme cases where it spikes to dollar levels. Just for the sake of the example, let's say this happens briefly and you cash out at $1. You bought 400 shares with those $4, so you end up with $400. Now I'm sure many of you will ask, why am I wasting your time with this simple math? Well, here's the reason, and I hope you listen very carefully. When people hear $230 per share, they think this is out of my league. But when they have the chance to make giant profits for $4, they think, why the heck not? People don't care for those $4. That's it. That's what it's all about. Penny stocks are available to practically everyone. Even if you end up spending $100 or $200, the profit margin is insanely bigger than the New York Stock Exchange or Nasdaq. This is when the gambling frenzy comes in. People can convince themselves of anything when greed takes over, and that's when the pumpers start taking advantage of them. There are several ways to spread a pump: emails, Twitter, chat rooms, even good old flyers. If you think about it, in itself, a pump isn't a bad thing. All it is really is an advertisement. The problem is that when we talk about penny stocks, many times those advertisements are filled with misleading statements or downright lies. They are a game changer. This could make them the next industry leader. Developed a unique system. Huge mega bagger. Let me stress something out. Vague words like could, may, probably, likely are put there so you can't accuse anyone of lying. Those are uncertain words that just cover how unlikely everything is. And when people start figuring this out, the whole picture usually comes down crashing. Let's take Pinga Fight for example. As you can see from the chart, the company exploded one day, just to be suspended by the SEC about 2 weeks later. We already covered this in our previous video. There we warned people that the suspension was coming, but few actually listened, and maybe a told you so is appropriate here. Just to make things easier for you, we'll provide a resume of the story. What happened was a 6.5 million pump that attracted extraordinary attention and excited many. But then reality kicked in. People found out that Pinga Fight doesn't have any means to carry out the claims made in the campaign. The company's financials were recorded with 2,000 in total assets, 62,000 total liabilities, no revenue since inception, and 100,000 in yearly net loss. This is the best way to figure out if you'll get burned. Just look at the financials. Groundbreaking technologies and business plans are great, but if the fundamentals aren't there to support them, the company isn't going to do much in the near future. Then, under spicy circumstances, came the suspension. Pinga Fight CFO Vlad Milutin suddenly resigned and urged the SEC to investigate the company, saying he couldn't bear the losses of the thousands of investors in what he called a pump and dump scheme. Mr. Milutin claimed that everything is related to a deal in 2013. Back then, 25 million shares were sold to undisclosed people at a price of half a cent per share. The highest session close during the pump was $1.37. Just for that day, a total of 22 million shares changed hands. Can you imagine the profits if those 25 million shares were all traded around that time? Let's do a quick calculation. The shares were bought for $125,000. If they were sold, I'm not saying that they were, but if they were sold at, say, roughly $1, that makes $25 million. What I'm saying may sound far-fetched or unbelievable, but come on, think about it. If someone paid $6.5 million for a pump, you can bet that that someone stands to profit much, much more. Although whether those sums are actually received is an entirely different matter. Pumpers often state whatever they want. The way we know how much a pump reportedly costs is by looking at the disclaimer at the bottom of the email. Pumpers state a monetary sum or an amount of shares that they received as compensation. If you can't find a statement, there's just one explanation. The promoter outfit is new and they need attention, so they're doing it for free. If they trade on the market and they bought shares, the law states that they have to say that. What usually happens in this scenario is that they buy shares at the beginning of the promotion, stated in the disclaimer, and when the price spikes, they sell everything. And that they are allowed, because they said in the disclaimer they would. Which leads us to the next subject. Selling large quantities of shares all at once is what people call dumping. Someone who has a lot of shares sells them when the demand is high, and because it gets suddenly sated, the price automatically goes down. People who buy at that point are left confused and angry since they just got in and are immediately at a loss. It's a public secret that most penny stocks experience occasional dumps. A lot of people on the internet even say all company insiders do it. Here's a breakdown of how this bit is done. If you're an insider, you need to file a Form 4 when you sell, unless the company's a pink sheet. Pink sheets aren't obligated to provide any information, and this is where most of the pumps happen. If it's not a pink sheet though, you need to file the form, so basically everyone knows you're doing it. But traders are scared of those forms. They associate them with dumping, so if you want to sell even massive amounts of shares without scaring the traders, you give money beforehand. To friends, people you trust, but not to family. The family is considered the same legal entity as the insider, so those people buy shares and later when the time is right, you tell them all to sell and then they return your money and the profits. You probably give them a little cut and everyone's happy, except the traders, you guys. Another public secret is the truth behind when a pump is sponsored by a so-called third unaffiliated party. This works on the same principle as what we just discussed. There's two ways it usually plays out. The company hires someone who becomes the middleman and goes to the promoters, or the company makes a financing deal where they issue shares on cheap prices for the money, and the financiers pay for the pump, because when share prices spike, they make a tidy profit. The final factor you should consider here is that sometimes dumps happen organically. See here? That's a sustained level, meaning people regularly buy shares at those levels. And when the price skyrockets, the experienced traders, those who've seen it before, they decide it's time to profit and someone starts selling. Then someone else starts selling. Then suddenly people are panicking and everyone's selling. And that's because someone knew how to play the pump, which is the last point we'll cover. First of all, the best thing you can do is to identify it on time, at the beginning. In this, there's nothing that can substitute doing your own due diligence. The same goes for avoiding pumps. Research. Look out for them. On our website, for example, we have a whole section where we update promotions every day. You can check those out. There are tons of utilities on the internet that can help you make a better judgment call. And above all, never forget better safe than sorry, which goes double for penny stocks. Everyone keeps saying this, yet nobody listens. Take profits when you can, or if you want to stay away from pumps, you should know this as well. Too many wait too long because of greed. Don't buy shares because everyone's buying the company now. People wait to squeeze every little drop of share price before it goes down. And at the end, they get caught up by the avalanche. Be moderate, but if you happen to be caught up and you see that the price is going down, don't wait for it to go up. Just swallow the loss and move on. Pumps can only stir temporary movements. Chances are, if the price suddenly drops during the pump, you won't be seeing good money anytime soon. This is Martin Nadenov for Hotstock.com.
I have a small amount of money to invest and I want to gamble in the market. I'm looking for a penny stock that'll go up and turn it into $100,000 or $1 million.